Is Seagate a buy or a sell? Let's get started with the model. This is a large cap company, 19 billion market cap. They're trading at $89 a share, and they have 212 million shares outstanding. This company owns half of the market for hard drives. Half of the hard drives in the world belong to this company. It is the world's leading producer of storage. It was founded in 1978, based in Singapore. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had a lot of free cash flow in 2022, 1.3 billion, but it was cut in half to 600 million in the trailing 12 months. Margins between 8 and 11%. Net income is the profit or loss on the income statement. It's revenue minus expenses. That also got cut in half from 1.6 billion to 800 million. It looks like they had a big impairment in 2023. They reported negative 529 million of net income. Revenue is a sales for the company, and that was 12 billion in 2022, down 37% to 7.4 billion, and down another 11% to 6.6 billion. They did complete their 2024 fiscal year. They already finished the first quarter of their 2025 fiscal year, and they're up. They're up 11% in revenue in the trailing 12 months. They're at 7.3 billion. They pay a dividend of 3.2%, which they can only cover one time with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, it's all cash flows past year 4, that's 24 billion. We discounted those numbers back to today using weighted average cost of capital. We get a value of the company of $22 billion. We divide that by 200 million shares. And we get a calculated stock price of 102. They're trading at 89, so they're trading at a 13% discount. It's a buy according to the model. Do you think it's a buy or sell? Let me know in the comments. There are 33 companies in the same industry as Seagate, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend about the average in CapEx, 212 million. These are the investments in property, plant, and equipment. Since they have negative equity, we can't look at their debt to equity ratio. When a company has negative equity, that means its liabilities are higher than its assets. They pay a high dividend, 3.2%, second to HP, they're at 4.3%. They generate 630 million of free cash flow, that's equal to the average. They rank 7th in market cap at 19 billion. We can't look at their price to book. They have negative equity, which means their assets are lower than their liabilities. They're trading at 23 times earnings, a little worse than the median, 30 times free cash flow, that's also worse than the median. But price to sales is better than the median, they're at 2.6. They generate 7.3 billion of revenue, more than Arista Networks. And Arista Networks is 7 times the market cap. But their revenue is going down. Their 5-year annual revenue growth rate is negative 6%. The only company worse is 3D Systems, negative 7%. They're trading 10% above their 52-week low. So it could be a good time to scoop up the stock. If you put $10,000 into this company when they started trading in 2017, by 2021, your $10,000 would have been over $200,000. But the stock came down a lot. If you happen to put $10,000 a year ago, you would have tripled your investment. But if you did $10,000 when they started trading, you'd be at $65,000 today, a 30% annual return. Still an amazing return, but you'd be really depressed if you were over $200,000 at one point, and now it's down to $65,000. To summarize, I have them trading at a 13% discount, ranking 6 out of 10. Short term, it looks like a good buy because it's trading pretty close to its 52-week low, 7 out of 10. Long term, 6 out of 10. I think it's good long term, but it is a little risky since their revenue has been going down a lot the past few years. Ratio is 5 out of 10. It's about average. They're pretty close to the median in most categories. Financials look awful, 2 out of 10. Their revenue is declining a lot. So is their free cash flow. Let's take a look at their income statement. They just completed their first quarter for fiscal year 2025. Their first quarter is a 3 months ending 9/27/2024. And this column is 2023. Revenue went up a lot from 1.5 billion to 2.2 billion. Let's see if they give a breakdown of the revenue. Of the 2.2 billion, 1.7 billion is OEMs, original equipment manufacturers. Here's a definition of an OEM. It provides components for the finished products of another company. So they're a middleman between them and the customer. They make the products for the reseller. The reseller sells it to you. OEMs are really focused on business-to-business sales, not business to the consumer retail customer. An example of an OEM is Tesla, Microsoft. $250 million of the revenue is to distributors, $170 million to retailers. Of the $2.2 billion of revenue, $1.1 billion is in the United States, $860 million Singapore, that's their home country, $200 million in the Netherlands. Last year, US was $455 million, so it more than doubled. Below revenue is cost of revenue. These are all the expenses directly related to generating the revenue. Their cost of revenue is identical to their revenue from last year. That's a pretty interesting coincidence. Revenue minus cost of revenue gives you your gross profit. That's 33%. They convert 33% of their revenue into gross profit. Last quarter was 32%. Last year, only 10%. So that improved quite a bit. Below cost of revenue, product development, $180 million. Product development increased $10 million when you compare it to last year. Last year was $171 million. The reason for the increase is due to an $11 million increase in compensation and other employee benefits. Also a $1 million increase in equipment expense, a $1 million increase in travel expense, a $1 million increase in lease expense, the cost for their leases, partially offset by a $5 million decrease in materials expense. The next operating expense is marketing and administrative, $129 million. Last year it was $105 million. That increased $24 million, mainly due to a $20 million increase in compensation and a $2 million increase in travel expense. That doesn't really add up. $20 million plus $2 million is $22 million. It went up $24 million. So their total operating expense is $1.8 billion, operating income $400 million. Last year they had an operating loss of $129 million, so that's a big improvement. They received $7 million of interest income. That's the interest on their investments. They paid $85 million of interest on their debt. So their pre-tax income, $316 million, $11 million of taxes, net income, $305 million, and they have 211 million shares outstanding. So their EPS is 305 over 211, $1.45. Last year, they had an operating loss of 88 cents. They did add 3 million shares. Last year, 208 million, now 211 million. Let's look at their balance sheet. $3.6 billion of current assets, $3.2 billion of current liabilities. So their current ratio is above 1. Current ratio is current assets over current liabilities. Their total assets, $8 billion, up from $7.7 billion. They have $1.2 billion of cash. Last quarter, their cash was $1.35 billion. It went down $119 million. And they talk about the reason it went down. They paid $147 million of dividends, and they spent $68 million on CapEx. That was partially offset by a cash increase of $95 million from their operating activities. It's interesting that their cash exactly matches their inventory from last year. This company has a lot of coincidences. Accounts receivable, $600 million. This is how much money is owed to them when they sell products on credit. $1.4 billion of inventory. Here's a breakdown of the inventory. $440 million of raw materials, $800 million work in process, $113 million of finished goods. Right before finished goods is work in process, and then before that is raw materials. In order to turn it from raw material to finished goods takes time and money. Then you have other current assets, $358 million. Here's a breakdown of the other current assets. Vendor receivables, $125 million. This is how much money their vendors owe them. $233 million of other current assets. Their biggest asset is PP&E, $1.6 billion. Their gross PP&E is $10 billion. They depreciated $8.7 billion, so the net value is $1.6 billion. Last year, they did $13 million of accelerated depreciation. They have to record the $13 million on the income statement. They added it to the line item cost of revenue. Then you have goodwill, $1.2 billion. Goodwill is the premium you pay when you acquire another company. Deferred income taxes, $1 billion. These are taxes they paid, but they haven't reported it on their income statement yet. The reason that happens is due to the way GAAP depreciates assets and the IRS does. In the long term, it evens out, but in the short term, they might have to carry things on their balance sheet. Other assets, $500 million. They have $9 billion of liabilities, similar to last year. Accounts payable, $1.8 billion. This is how much money they owe when they buy on credit. Accrued employee compensation, $148 million. They owe this money to their employees but haven't paid them yet. That's why it's a liability. They owe $500 million on the current portion of long-term debt, and they owe $5.2 billion on the long-term portion of long-term debt. Here's a list of their debt. There's $479 million due this year. That's why it's in the current section. That debt was due on January 1st. At the time they published this 10Q, they owed that money. And this is all their future debt payments. The interest rate is 4.8% on this one, 4%, 3.1%. This rate is high, 8.25%, 500 million. This is even higher, 8.5%, 9.6%. I guess they're a credit risk. So you can see here, 479 million of debt is due this year. Nothing next year, 500 million in 2027, 1.5 billion in 2028, half a billion in 2029, then 2.7 billion after 2029. Here's a list of the debt, but this is easier to read. So you can see the interest rates right here. Assets minus liabilities equals equity. They have negative equity, negative 1.3 billion. We saw that when we were looking at the industry comparison, because we couldn't look at their debt to equity ratio or price to book because they had negative equity. They raised 7.5 billion from selling stock. They lost 8.8 billion from running their business. Let's look at the statement of cash flows. Here's operating cash flow. They generated 95 million. Last year, 127 million. Even though they had negative net income last year, they do have positive cash flow because they had a cash inflow of 100 million from accounts receivable, a cash inflow of 88 million from inventory. The way you have a cash inflow from inventory is when you sell inventory, you receive cash. In this accounting period, they spent 144 million more on inventory than they sold. In their investing section, they spent 68 million on PP&E. In their financing section, they spent 147 million of dividends. They paid 28 million of taxes. That's taxes to the equity awards it provided to its employees. And they received 29 million from selling stock to their employees. Let's look at a company on Simply Wall Street. It's last priced 18 billion market cap, up 2% in the past week, up 11% in the past year. It looks like they started trading in 2003 at $9 a share. Their low point was in March 2009, $3. It ran up to 65 by 2015. It traded sideways over the next 6 years. In 2021, it was 61. It reached its all-time high in December 2021, 114. It came all the way down to 50, then ran back up to over 100. That was in October 2024. But since that peak in October, it's come down a pretty good amount, about 20%. Simply Wall Street's valuation is 112. They say the stock is 21% undervalued. 20 analysts priced this stock at 118. They say it's undervalued. Here's their debt since 2014. It was 3.5 billion. It peaked at 6.2 billion. It's come down a little bit to 5.7 billion. But as their debt goes up, their equity goes down. Right now, their equity is negative 1.3 billion with debt of 5.7 billion. They do have enough cash on their balance sheet to service a debt, 1.2 billion, which is about 20% of their debt. The way I look at it, a company needs at least 10% of its debt to stay afloat. The CEO's salary in 2018, $950K. Total compensation, $14 million. Tenure as CEO, 7 years. In the past year, only insider selling, no buying. 90% of the companies owned by institutions and 10% by the general public. Vanguard is the biggest shareholder at 12%, then JP Morgan at 9%. State Street at 4%. Geode at 2%. Invesco at 1%. And the bottom of the list is Citadel, 0.6%. Their employee count has gone down from 52,000 to 30,000. And the ticker trades on the NASDAQ, Wiener Börse, Mexican Bolsa, EuroTLX, Deutsche Börse, and Sao Paulo Bolsa. So if you want a copy of my discounted cash flow model, click on the video in the top right corner.